Hello and welcome to another edition of Nucleus Investment Insights. This week we are looking at China stimulus. So we had some recent announcements out. We have Dave on the other screen as soon as I can find it. About to drop in. Hi, Dave.
Hey, mate.
We thought what we'd do is have a bit of a chat about is it the long-awaited stimulus finally here? What parts of the announcements are real? What parts aren't? What are the macro implications? We've obviously seen a pretty good metals rally off the back of it. What does that actually mean? And where are we going to go from there? So before we start, if you want to hit the like and subscribe button if you like this stuff, we're on every Thursday at 12:30. Feel free to drop in any questions if you have any. We can answer them as we go. But other than that, I thought we would jump straight into these slides, Dave. And we'll look at what's going on. Sorry, before I go, just a quick note. Everything you hear today is general in nature, not personal financial advice. If you do want personal financial advice, please come to us at our website or give us a call.
Yeah, so the agenda is China yawnulus, as I call it these days, because stimulus this is not your grandfather's stimulus. So we'll go through where it's weak, look at what the real problems are, especially in interest rates and property. Then we'll have a quick look at steel and iron ore, and wrapped up with kind of top-down take for markets on what it all means. So straight into it. So there was kind of two-pronged. It was a two-pronged stimulus that was out a little while ago, and it aimed to lower mortgage rates and kind of buying restrictions for property on one hand, and on the other hand, it was adding some fiscal firepower to an attempt to reduce idle inventory of unsold property stock, which is, there's a sort of enormous overhang of these properties that are obviously weighing on prices as well as developer balance sheets and sentiment in general. And so, kind of not unlike some of the toxic asset fiscal mechanisms that were used by the US and the GFC. This was trying to sort of buy up some of that toxic inventory and clear it out of the way. However, on mortgage rates, we'll come back to that, because there's the real problem here is real interest rates, and so they're not low enough. And on the second component, which is the buying of these toxic properties, it's not clear how it's actually going to work. The problem is you can't just buy the inventory at face value. You have to buy it at a discount, or it'll be far too expensive. And by doing so, of course, you're going to force down prices all around that inventory. So that's probably the number one problem with doing it, is how to do it without actually sinking prices even further, which of course will then crowd out any rise in sentiment and private sector buying whilst that process takes place. Now, ultimately, it might help clear the market and give you a restart, but while it's transpiring, it's only going to make it worse. And there's just far too little funding for it as well. So some of the pilot programs that have been used haven't gone very well. Not enough money, not enough willing sellers, not enough willing buyers, just a whole bunch of really sticky problems that don't appear to be going away anytime soon.
I think as well with a lot of bailouts, it's a bit of a Jedi mind trick, isn't it? In terms of you need to actually convince everyone else that this is safe and we've got a floor or level or whatever, and then so I think there's just trying to think. There's some Fed stimulus with the Fed stimulus with the corporate bonds in the pandemic is a great example. Fed says, "Yep, we're going to step in and buy all these corporate bonds at this level to clear it all," and then they never had to because the market sorted it all out for them.
That's right.
And I think that's this thing with the Chinese property, isn't it? It's saying, okay, it needs to be big enough and credible enough and all that type of stuff that actually don't need to do it because all these people are going to then suddenly flow in and want to buy all these apartments.
Which
but
it just isn't. I mean, and this is, there's a big difference between Beijing and the Fed. I mean, the Fed has unlimited resources, and can just print, especially when you're in an asset deflation environment, can just print till the cows come home, and it's unlimited money, and that's, as you say, that's the whatever it takes moment that will turn sentiment. But this is not that. This is limited public funds, some sort of SOE involvement and things, but it's heavily capped fiscal spending. So it's just not enough firepower by a very long way. I mean, if it was the PBOC buying this stock and saying we're going to clear the market, then it may well work, but it isn't. So it's not going to. Interestingly, though, I mean, the PBOC started talking about sort of establishing a bond buying mechanism yesterday. So they are preparing some mechanisms for quantitative easing.
So bond is in government bonding bonds, or not developer bond?
No, sovereign bonds. Yeah. And so you could. They're looking very sheepish about it, and I don't expect anything to land on the property sector in the near future. But China spent a lot of time criticising quantitative easing after the GFC, and they're sort of headed that way they're themselves now, slowly but surely. So as a result of sort of insufficient stimulus, yawnulus, if you like, credit demand basically continues to fall in China. Broad credit, which is a pretty good leading indicator, which is the stock of loans, total social financing, that is, not just bank lending, so it's all sorts of different stuff, government bonds and whatever. It's still only just above a record low in the last month. The M1, M2 spread, which I don't want to get too technical about it, but these are sort of monetary measures that incorporate the various sort of money components that float around, everything from deposits to money market funds and everything in between. Basically, the M1, M2 spread has been crashing, and that's sort of suggesting that a lot of the liquidity that is available is getting stuck in the banking system. And this is a classic sort of debt deflation symptom.
And so this is this whole pushing on a string thing, isn't it? Where you're basically they're trying to pour money into it, and the banks are going like, we've got all these bad debts. We're not sticking that money out in the economy. We just want to hold on to it, and hopefully we'll make it through this without going to prison or
exactly right,
or losing your head.
Yeah, and the signals out of Beijing are pretty mixed on whether this actually is what they want, like a real bailout. And so, in fact, I think the signal's pretty clear they don't. And so a bank's going to be pretty hesitant, to be participating in trying to juice property in that environment, or a banker, I suggest, who wants to live to see another day.
Well, and that's it's an interesting factor, and I'll say it it's sort of a trite way, but it actually is really important. Is that in a Western economy, or say the US or Australia, if you're a banker, you have lots of upside risk in terms of things go well, you make these massive bonuses. If things go badly, usually the bank will take the rap for it. You'll probably get another job somewhere. You might get a golden parachute. Like, your upside downside risk. And we've been through these banking crises, royal commissions, and nobody gets put in jail. And the whole US one, and they picked one Frenchman to stick in jail. And so your upside downside risk is very skewed. In China, they often execute people who stuff up. Like, it's not like your upside is, I might make a bit of money, but I'm probably making that money anyway. There's probably not, and you don't have the same up bonuses, but your downside risk is I could die.
Yes, exactly right. So you're going to do what you're told. So
you're going to, and if you're unsure, you're not doing anything. Yeah.
No, exactly.
I'm like, here's somebody's saying to you, here's some money, maybe you should get out and use it as stimulus.
Yeah.
And you can read something else that says, don't make bad loans, otherwise Otherwise you're gonna pay for it, and don't funnel this to people who might be your friends.
Yeah.
And so you're just going to sit on your hands and go, well, upside downside, I'm going to wait until I have it in black and white. And that's been Xi's problem as well, isn't it? Is that Xi's trying to centralize power so much that everyone's seeing everyone else go to jail, and well, unless I can see exactly what he wants to do and tells me in black and white in Xi thought and driven down, I'm not going to do it.
We'll come to what he actually wants on the next slide, actually. But I don't think he wants a property rebound. Anyway, so we're still seeing private sector debt deleveraging. We've got a fiscal pump running that's keeping the Chinese debt machine ticking over, but the private sector, I think total social financing was down 1.7% year on year in the private sector in China in the last month. So it's it's an incredible turnaround from the heady days of endless Chinese credit.
Yeah. And it's even a bigger change when you talk nominal numbers as well, because nominally that's, whatever it is. So down 1 point something is down, probably down a little bit anyway in terms of nominal figures. Whereas even when you're talking about, the Chinese economy growing at, 4 and 5%, that usually had 4 or 5% inflation on top of that. Yeah. So it was growing more like 10% in a nominal sense. So if you've got lots of debt, my income's increasing. Well, most things are increasing at 10%. My debt staying steady. Yeah, we're all good. To now, where it's no nominal growth, and and so
it brings us to the real problem. I'll just note quickly that domestic demand's very weak, and they're very reliant on exports, which is going to become a problem later this year. And so, but the point Damo's making about nominal growth and credit growth, really comes to bear in real interest rates, and this is the real problem that China has right now, and that is it's got so much deflation that its real interest rates keep rising, and they're actually, despite all what easing we've seen, and there's been a lot of mortgage rate cuts now, we're still seeing the highest real interest rates in 8 years, in 9 years, in fact.
So nominal rates are really low, though. So nominal Chinese interest rates are lower than they've been. But but the point is, well made. It's that when you grow, you're used to having interest rates of 6 or 7%, and the economy growing at 10, and now you've got interest rates of 3 or 4%, and the economy going back to, or growing at 0.
Yes, and so this makes it very difficult to service debt. And so, there's a debt revulsion out there. So demand sucks as well as supply in debt. And so this is not an environment in which you're going to get flourishing property. The question is why, and this is where we come back to Xi Jinping and his goals. I think there's two main reasons why the property shakeout has been encouraged to run, now for 3 years and counting, with more to come.
Yeah, and in a way, 5 years with a 2-year interlude.
Yeah, that's right.
For COVID.
Excuse me. The reasons. The first reason why is Beijing seems determined to try and make the yuan into a reserve currency, and so it wants to keep some kind of yield spread. And doesn't want to succumb to the low interest rate environments of other crisis economies. But by doing so, of course, it's creating this real kind of deflation black hole that inexorably means that rates are going to have to come down. And for instance, the sovereign spreads have all absolutely cratered and are still coming down, and are duration is about Australian or US rates now. The 10-year in China is about the same level, but still falling. And the second,
and actually, that's when you're talking real rates as well. I mean, that's the part where if it's the same level as Australia or the US, and typically as emerging economies, you'd expect to be running higher inflation rates, sort of more like 3 or 4%.
Exactly.
And so so you're basically looking at longer term, people are basically going, over the next 10 years, there's expect 0% sort of real rate or 1% real rate.
Yeah. So, I mean, the currency, I guess, is a geopolitical play by Beijing. I don't think it's got a lot of macro sense in it, but that's what they want. And the second component is really the macro, macro and microeconomic driver of why they undertook this property smash in the first place, and that is demographics are sinking, and they've simply built too much property. And so it's turned into a giant kind of disproductive sector of the economy where it just sucks in capital and produces very little other than more apartments that nobody needs. And so they want to restore their productivity growth to help lift incomes and restore income growth to the economy. Now there are limits to that as well. Most of them being political, but that's I think his basic objective, and I don't think that's changed. So I don't see any end to the deflation. It'll ebb and flow, of course, probably around the global industrial cycle because they're so export dependent now. And any further stimulus will be more of what we've seen, which is not enough. Chasing its tail into this property kind of black hole, which shows no signs of a bottom. And as I say, I mean, if you're not going to address real interest rates, then there's just no end in sight to it. So where does that leave property and China? Basically, more price falls ahead for Chinese property. I suggest they're already down. I mean, different measures indicate different things, but somewhere between 20-25%. I wouldn't be at all surprised to see that much more again over the next 5 years, say, before this thing's really over. And in part, I think, is a demographic question as well, because property is just so expensive they can't get young people to form households, and that goes to the demographic problem they've got, where the aging population is going to start creating all sorts of headwinds for growth. More property floor area sales falls. Now, you have to ask yourself how far it can fall, because starts, at least, sales are already down like nearly half. Starts are down 70% from the peaks in 2021. But I just think there's more to come. I mean, there's not much of a sense of any rebound. I did provide a chart a couple of slides back showing what response there'd been to the property stimulus, and it was pretty lukewarm. There'd be, a little bit of extra foot traffic, but it's already rolled over after a few weeks and is on its way down. Excuse me, and starts and sales are just dropping, 20-25% like clockwork, year on year, every month. It just doesn't appear to have turned at all. And so, of course, that means more construction volume falls ahead. And, where I didn't provide this chart, but, the stock of floor area construction in China is down like 13% or something from its peak, whereas the flow in starts is down 70%. And so that gives you some idea of the gap that has to close before we can say this market is going to clear in terms of construction volume falls. It's an immense fall ahead still. And Goldman is kind of coined a pretty useful term, a completions cliff, that they expect to get quite intense next year.
You've got a few questions on that, but let's just jump quickly to yourself.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. Sorry. So completions cliff. So sorry, I don't know if maybe I have seen that, but it's. Do you want to explain the?
So basically, when a builder builds a building, there's a sale, then an approval, then a commencement, and then a completion in the data. It's the final stage. And so the gap I'm talking about between the number of starts, that is the flow of building, versus the stock, which is the stuff that's already under construction, which is much higher than the starts in China. That gap has to close by completions falling away.
But also though as well, I guess my issue with that one, and you and I obviously have had lots of discussions about the Chinese data, which is terrible in terms of nothing adds up. Doesn't if you sort of if you've got A plus B should equal C, well, it just never does.
No, and said usually.
And so the issue I've got is there's this huge supply that's notionally under construction, but I don't know how much of that is, okay, I've turned a shovel of dirt and so now I'm under construction, but I've actually done nothing else. And so whether that's still yet to come on versus the one which is actually I've built, I've put up, 30 stories and we've got a shell, but then I ran out of money. And so we haven't been fitting stuff out. Yeah. And so I guess that's the part about sort of feel like, the starts have finished, but there's so much that was potentially under construction. We don't really know whether it's really started or really going that who knows how long this is going to go for in terms of.
That's definitely an open question without doubt. Goldman's calculations for the completions cliff were just based on previous year's sales,
right?
And using a kind of 2 to 3 year
construction time frame.
Yeah, construction time frame based on their model. It starts down 20% year on year now, and are looking quite shaky. And so I actually think we probably are going into the completion, something of a completions cliff. And, the gap is so huge that it's likely to be meaningful, even though we don't know exactly how big it really is and what the timing will precisely be. But it seems reasonable given, things like, rebar output are down, quite a bit, like already, sort of probably around 25% already. So that's telling you that a lot of that demand has already come out.
Yeah. And that's the other discussion we've had, isn't it? Is that when you're building an apartment, and let's say steel is a good example, is you need a lot of steel at the start. And so if it's going to take you, if you've got a 2-year time frame, which is unrealistic for most Western countries, but in China, 2-year time frame is probably all right. Is you got 3 or 6 months worth of planning approvals and all that type of stuff. 6 to 9 months of we're sticking stuff up in the air and using all the steel, and then the last sort of 6 or 9 months of fit out and all that type of stuff when you don't use the steel or use very little of it. And so, you sort of front loaded, whereas something like copper is back end loaded or I guess maybe you're looking at, things like zircon and stuff, things that you might use for paints and for bathroom fittings and all that type of stuff is back loaded in terms of these.
Steel output's down, I can't remember off the top of my head, maybe 5% from the peak. It's down 2% year to date. And I just expect it to keep falling. There is one more component to that for those who are interested in trading steel and steel inputs over the second half of this year, and that is the recent travails around scrap steel and electric arc furnaces, which had the output of which had absorbed nearly all of this shock in the last 2 years.
Yep. So you might want to explain that in a little bit more.
I will. So what has happened is there's two types of basic steel output in China. There's blast furnace, which uses iron ore and coking coal, and then there's electric arc furnace, which uses scrap steel. It's recycled steel. Now, over the last 2 years or so, as Chinese steel output has fallen, it's nearly all fallen in the recycling component. And that means that pig iron output, which is what you get out of a blast furnace, has just been stable. Like, it hasn't fallen, even though. So this is one of the key reasons why iron ore has remained quite expensive, about over $100, is because the adjustment has fallen on scrap instead of blast furnace steel. So, however, like
before you jump into that though as well, like which has been a real quandary for us, hasn't it? And like,
it has.
Because scrap steel is way cheaper to produce than producing it.
It is. Well, it should be.
But the biggest cost is the electricity, which is, we went through the energy crisis. But so that's one of the pieces.
I don't know. Like, the coal price was very high, and electricity was expensive, and that probably played a role. Maybe for some reason the margins were better in blast furnace steel than the electric arc furnaces, but there's no doubt that mills oriented very much towards blast furnace output for the last 2 years over recycling. And it was so strong, and it's so against the 5-year plan which is supposed to go the other way. It's supposed to be all about recycled steel. That I concluded that China must be preparing for war or something, because it was trying to preserve the steel stock that it has, not use up its scrap steel, keep it as an inventory, if you like, and just use imported iron ore whilst it's leading up to war. And then it's got plenty of inventory in the event of war, and the iron ore trade gets shut down. That was my thesis. But then, like, the next month, they freaking turned around. The NDRC came out and said, no, we need to smash carbon emissions in the steel sector, and went straight back to the 5-year plan virtually and said, we want 50 million less tons of blast furnace steel output. And that's why the iron ore price and iron ore miners have been hit quite hard in the last month, is after that pivot took place. So as we look into the second half of the year for iron ore and whichever particular type of steel, there's a real double whammy kind of growing, where you'll have both the ongoing headwinds of the property adjustment and further falls in output. And they've actually said they want to cut output absolutely, as well as in component terms. And then you'll have a shift to recycling as well. And so it's a double whammy for blast furnaces and iron ore that's coming. More falls in iron ore is what's coming, and this is all before we get to 2025 and our completions cliff, and then the end of the year we get Simandou iron ore out of Guinea, which is another sort of 100 million tons landing on the seaborne market, and we've got like about 100 million tons of expansion between then and now as well, just in incremental gains from all the majors. So it's a very nasty picture for iron ore that's developing, despite the fact that it's outperformed admirably for the last couple of years. So I'll wrap this up with a sort of top-down view of what this means for Australia and asset markets. I think it is inevitable that Australia is going to enter.
Actually, I'm going to cut you off there, Dave, for a second. I'm going to go to a quick sales message.
Sure.
Then we'll come back with the investment views.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, sorry to cut you off, Dave. Investment views. So
Sure.
I'll just say we've got a comment in from Alex. Sounds like another vote for Sell Australia, Buy the World. But I think that's probably stealing your punchline.
I'd say that's not a bad assessment, especially given the other sort of themes that we see developing in other developed markets, AI and weight loss drugs, automation and EVs and all those things. We think they'll all be very good for corporate profits, much more in other economies than the Australian economy. So combine that with an income shock that we think is inevitable for Australia. And we've seen this before. We lived through it in 2015-16. It has very predictable consequences. The first one being you get incredibly weak nominal growth and very weak wages as the nation's kind of pay packet is slashed. That actually trickles down pretty quickly to wages as well. And so it's a very deflationary thing to go through. And that's what we saw after 2015, where interest rates effectively fell for like 5 years into the pandemic, a long way as well. Like, I don't know, remember exactly.
It's probably saying disinflationary rather than deflationary. Should I say
Yes, no, you're right. It should be disinflationary.
Yeah.
I can't remember how far the cash rate fell then, but over that period, but it would have been, it was like 300 basis points or even more, I think. Maybe even 400. I can't exactly remember, but it was a lot. And you would see
that was that whole RBA saying, "Hey, wages are about to bounce back. We shouldn't cut rates too much." Then a couple of 25 basis points. Exactly.
Just horribly wrong.
Yeah, just like one more year.
Exactly right. Yes, and so that's what we would see again if we got a similar scale income shock, which I think we will. Similar scale. You see rising taxes, falling tax receipts, and rising taxes.
Yeah.
Very nasty, given where Australia already is, where we have this household sector that's just being bashed to death.
Yeah, but luckily we've given away all our current tax receipts in income tax cuts just as inflation's booming. So we'll have nothing left.
No, we won't. I mean, this would be really nasty because, as I say, Australian real income growth has been destroyed like by 7% or something over the last 2 years. And then you're going to hit it with this. I mean, it really becomes a disastrous period for Australian living standards as you go through this. Now, it will, of course, be hidden by Canberra as it pulls the only lever it knows how, and that is to increase immigration. I mean, probably can't go back to where it's been over the last 2 years, but it will certainly sustain it at very high levels.
Yeah, it'll pitch it now as like we have a new high watermark of whatever it was, 700,000.
Yeah, well.
So if we bring in 350,000 people, which is whatever it is, 100% bigger than what we used to do, it'll still be pitched as we're 50% down.
Well, that's right, and
on the highs.
And we need to return to normal, which is 550. That's very true, but I mean, they don't have another idea in their empty heads, so it's likely what they would do. And of course, that's very deflationary as well, and it just guarantees all the income shock is shifted from corporate profits to wages and households.
And so the other one,
I don't know. At some point, basically, as far as I can see, Melbourne is already melting down into a kind of violent melting pot. Get off my lawn!
Get off my lawn! Get off my lawn! Yeah.
So if you add
before you go into that though, can I just give the other side of the politics? Is so let's say we do go through a change in and we have Prime Minister Dutton.
Yeah.
The expectation would be that it's not going to be that different. Like you might have 50,000 people.
Well, he has committed to much lower immigration, and given that would probably be the reason he's elected, he'd be loath to backflip on it, I would think.
But do you think though he would run genuinely lower, or he just like
look,
cut the humanitarian?
It's a materially lower number.
Yeah, but I guess I'm saying that the Howard bait switch of like you'd be really really cruel to a bunch of people, and then highlight that, and then but actually open the doors.
There are so many ways of doctoring the immigration numbers that yes, they'll find hollow logs to pull people out of and hide them in, and they'll be definitely doing that stuff. So I mean, you know, the number one outcome of all this is lower interest rates, which will be a lot of relief for mortgage holders, of course, but not that much of relief given their real incomes will still be getting hammered. Bonds look good in this environment. Obviously, you know, you want to be underweight miners, and the Australian dollar is not likely to be very strong either, as rates come down further than elsewhere, which is very off the radar at the moment for Australia. But this would absolutely cure Australia of any inflation problem, and rates would come down even more than elsewhere. So because this sort of adjustment, like after 2015, it was still running in 2019, that adjustment. Like these income shocks are long and grinding and difficult. They take ages to get through,
but nobody believes them as well. Like that's the thing with income shocks is that you go, you know, and think about it, if you were. This is we were talking about income shock for the entire nation, but it's so similar to an income shock for an individual. It's like, well, I was just earning 100,000 or 150,000 or 200,000, whatever it is, and I've had to take a lower job, or I've got to change. You know, that's my benchmark now. That's what I think I'm going to get back to, regardless of whether you can or you can't. It's actually takes a while to go through that 7 stages and denial and eventually acceptance.
It does. Well, I mean, we called the last decade the lost decade. I don't know what we should call the next one. Probably shouldn't be said on national TV. So, but I mean, the other thing that recommends itself in this environment is if you're going to have strong immigration and much lower rates is property, of course, and so you will, you know, probably see another leg up in the disenfranchisement of Australian youth, as they always end up wearing, you know, these adjustments on the chin in Australia. And so that's about the wrap there, Damo.
Yeah, excellent. Thanks, Dave. That's I probably might leave it at that, given where we are. I don't think there's any more questions. So just to highlight, you know, if you want to sort of listen in, we're on every week at. Sorry, let me find my final slide. So we're on every week, 12:30 Melbourne time and Melbourne Sydney time. You can get more from us at nucleuswealth.com/content. You can get us on all the different social medias, number of different. I need to update this slide because I think Google Podcasts is just about to disappear, but you know, you can get us on YouTube, soon on the YouTube podcast, Apple Podcasts, Spotify, all the major and minor podcast platforms. You can listen in, and if you've got any questions or anything, either pop it on the one of the pages or send us an email, and we'd love to hear from you and what you're looking to hear about. With that said, thanks, Dave, for coming on.
Pleasure.
And we will see everyone next week.